returns from most asset classes were positive over the quarter. Developed market equities added 0.5%, led by Japan. Investment grade bonds, that includes both sovereigns and corporates, added 0.9%, and global listed property added 3.5%. But if we compare this to the first half of the year, when equities added 9 and 17%, the pace of gains has clearly slowed, and there are also areas of weakness during the quarter, notably emerging market equities, which fell 2% in local currency terms, and more so when one takes into account FX. What is driving this is evidence of a global manufacturing recession and uncertainty surrounding the US-China trade war, and whether this will ultimately push the broader global economy into recession. Central banks responded to signs of a slowdown by easing policy. The European Central Bank reduced its deposit rate to negative 0.5% and resumed quantitative easing at a run rate of 20 billion euros per month. The Federal Reserve cut rates twice, but indicated it doesn't expect further cuts either this year or next, which puts it somewhat at odds with the market, which is already pricing in at least 2 additional cuts. There have been no quick wins on the trade front. Both the US and China need a deal to be done. Trump needs something because an election is in sight, and Xi needs something because the Chinese economic slowdown is accelerating. Both leaders, however, like to be seen as tough, and hence concessions won't be easily given. This is not solely about trade, however, on which we would expect to see some progress before the end of the calendar year, but things like forced technology transfer, theft of intellectual property, and cybersecurity, for which there are no quick fixes, irrespective of who ultimately takes charge of the White House. Another major area of geopolitical uncertainty is the Middle East, following the drone attacks on the Saudi oil production facilities. Given the rapid relative decline in the importance of oil in the global economy, the risks associated with the Middle East instability are much diminished compared with earlier years, but remain a threat and additional source of volatility in markets. Finally, as for Brexit, both sides have moved a reasonable distance, which is positive, but all options, be that a deal, a further extension, even a hard Brexit, very much remain on the table, and the situation continues to evolve very quickly. The funds are either in line or ahead of their cash plus targets over their respective holding periods to the end of last quarter. Similarly, the funds are performing in line or ahead of their targets over the previous 3 years, which suggests we're on track to continue delivering on those targets going forwards. Cautious return plus 2.7% per annum net of fees, managed plus 5.7%, and growth plus 7.3% over that time. The past 12 months have been a period to own duration, that's long maturity fixed interest paying bonds. To give you an idea of the moves, treasuries with a maturity of 7 to 10 years have outperformed treasuries with a maturity of 1 to 3 years by 10% over the past year. Now, we prefer shorter term bonds and hence be on the wrong side of these moves, which has detracted from performance. We continue to believe the market is overly pessimistic about the outlook for interest rates, and that investors are playing a dangerous game by buying bonds at these low yields, which will quickly be eroded if we get any return of inflation. Balance sheet repair takes a long time, but it is happening, and there will come a time when people start taking up more credit and spending, and inflation may therefore rise. Similarly, there's a growing consensus that fiscal ratios are not taking into account the low level of interest rates, and that more room for easing in fact exists. And hence we expect to see some fiscal expansion, which again is inflationary. We reduced equity in July. Valuations, while not overly rich, did not fully reflect the risk of an economic slowdown, plus other macro risks in our opinion. Where we saw better pricing was in dollar-denominated emerging market debt, short duration US high yield debt, and floating rate loans. So we added some exposure there at the same time. We also actively traded our government bonds, focusing exclusively on US treasuries in the 6-year part of the curve, plus a long maturity US inflation protected bond that matures in 2043. We also added some listed property. Property market has done well year to date, and hence it was not necessarily a clear buying opportunity, but our preferred active managers sitting on a portfolio of assets in the UK, in Hong Kong, and elsewhere that we consider to offer excellent long-term value, hence now was the time to add. What will drive markets in coming months is the state of the global economy. Today, the weakness we are experiencing has been driven by trade and manufacturing, while the key service sector has remained firm. Employment has been strong and the consumer is generally in good shape. It is not a foregone conclusion that conditions will get worse from here in our view, and hence we're not outright bearish, but we're constantly looking at ways to build protection into the funds. Rates markets remain expensive today, with several additional cuts already priced in. Hence, if we don't want to own these bonds at these kind of prices, then we have to build protection into funds in other ways. Via real assets, that's property and infrastructure, gold, and also short duration bonds. Corporate credit valuations remain at best fair, at worst expensive, so short duration remains our favoured way to take credit risk today. EM debt remains attractive in our view, but we're not looking to take EM FX risk, and therefore we own dollar-denominated debt. Finally, infrastructure and property offer diversification and yield, and hence we favour an allocation. As you would expect, we'll be responsive to the incoming data, whether that's economic data or changes in market prices, and hence these views will change, but this represents our current outlook on markets.